To me, there was only one investable asset in the crypto landscape, and that is Bitcoin. It was the first, it was the best, it was the only one that hasn't been corrupted. Back in 2016, we used to spend 50% of our meetings talking about Bitcoin. We framed it as a 1 to 2% allocation of your portfolio is the equivalent to a bad day in the stock market. As a percentage, 1 to 2% of a client's assets, no one cares, let me tell you. No one even blinks an eyelid at it. But fast forward when that's gone 100x, it's now 50% of a client's portfolio. It's a very different conversation, and clients are laser focused on this thing. And for new clients, we spend all our time talking about Bitcoin because it's the most important asset we can be talking about from a future return perspective. And so I can say with full authority and authenticity that I genuinely believe that there is 100x in front of us over the next 10 years.
Hey Pete, welcome to the Bitcoin IFA podcast.
Pleasure to be with you, Dan. Looking forward to this one.
How are you doing today?
You know what? Life is beautiful. Down under, it's a glorious day here. Sky is blue. It's about 21 degrees and not a cloud in the sky, which is a lot different from what the last week's been. So we make the most of it.
That sounds great. Yeah, it's very early in the morning in the UK. We're doing this with time zones. Pete, we like to start each episode with the same question for everyone. So everyone is against Bitcoin until they're for it. What's your Bitcoin story?
I was first introduced to Bitcoin by my brother, who made a very subtle suggestion to me that I should buy some back in 2011 when it was $3 a coin. And I swiftly told him, because I was a finance guy, I told him how stupid that idea was. I told him that the governments were going to shut it down. And then I proceeded to lecture him on the fact that, oh, look, that's good, but there'll be a new technology that comes along, the old MySpace v Facebook argument. And then what I'm very disappointed to tell you, but hope that some of the people listening to this will benefit from my stupidity, is it took me about 5 years of speaking to my brother every other day to really understand Bitcoin. And I'm disappointed to say that it probably took me over 200 to 500 contact points asking questions about Bitcoin before I understood it and made an allocation to it. So sadly, that's how I got to it. And then it's just a one-way ratchet. It's like a one-way valve after that. It's, you start going down that rabbit hole, and the more you see, the more you like. And that's very different to every other investment that we've advised on.
Yeah, I think that's a fairly similar journey for most. Multiple touch points. I'm willing to do the work, the research, and it can take a bit of time to really get your head around Bitcoin. And that complexity thing is actually something that we'll touch on a bit later. For now, I believe, Pete, you've had over 30 years in traditional finance or finance in general. So can you share a bit about your journey from being a traditional financial advisor to founding the Bitcoin Advisor?
Well, I over 25 years, so 3 decades in finance, and it all started with a degree in accounting and finance. I quickly figured out I didn't like the ambiguity attached with marketing and management courses, and I liked the sort of stricter disciplines of accounting and finance that had more rigor to it, and there was a definitive answer rather than a subjective one. From there, I went into BT Funds Management. I'm sure everyone's heard of Bankers Trust, but there was a Bankers Trust when they sort of went through their split, was bought out by a company, Principal Asset Management in the US, that retained the BT Funds brand in Australia. And that was my first job out of university. I was there for a short time before moving across to the other side of the balance sheet as a credit advisor, where we gave advice on all sorts of credit. And I was there for a number of years until such time as one of my father's advisors and great mate told me a year before the GFC that I was on the wrong side of the balance sheet, and very swiftly restarted all of the advice and regulatory approvals that I needed to get back to the other side of the balance sheet or become an investment advisor or financial planner. And so that was GFC, went through that, moved to the other side of the balance sheet, specialised in a very niche area of our pension products in Australia called superannuation, or in particular self-managed superannuation funds, and basically had an equivalent of a master's degree in that on self-managed super funds, came up with a whole host of really interesting strategies, ended up becoming one of Australia's, if not Australia's, preeminent specialist on limited recourse borrowing arrangements, which is a fancy term for borrowing money in your pension, which was technically not allowed, but a brilliant lawyer who has done so much work in the Australian field of law and finance, John Denevant, created that and was very gracious to sort of spend time with me to help create a course for the mortgage industry. And then focused on a family office, or a multi-family office, a bit over 10 or 12 years ago now. And a few years into it, it took me a little while to understand what this Bitcoin thing was. And in around 2016, we started advising all the families that we look after to buy Bitcoin. And I guess the rest is history. We've always focused our investment advice on, say, the faster or more perceived to be riskier assets. So it was always NASDAQ sort of technology, and Bitcoin heavily skewed towards that. And in creating portfolios, we haven't liked, or we never invested in bonds because we thought they represented an existential risk to a portfolio because there were negative real returns on that. So fast forward to where we are today, and about 2 years ago, going down that Bitcoin rabbit hole, and then having all the families I look after with fairly substantial holdings in Bitcoin, was able to create a business that I thought was applicable for all clients, or anyone globally who's looking to self-custody their Bitcoin. And hence the Bitcoin Advisor was born on the back of the work that we'd done for the last 10 years with our families.
Blimey, what a journey.
Yeah.
And the Bitcoin Advisor seems to be going great guns, so congratulations for that.
Thank you very much. It's a lot of fun.
I bet. There's a lot I want to touch on there. So advising on Bitcoin in 2016 is very early. I'd like to touch on the challenges that you faced with that transition. But before that, you mentioned that bonds were getting negative returns even that far back, and that's how you base your investment thesis. What do you mean by that?
Well, we never really liked investing in bonds because there was a negative real return, in that we were conscious of the fact that the bonds were returning, say at the period in time, it would have been somewhere between, call it 4 to 5%, but there was no protection on the asset base or the capital that you invested, because it was effectively fitted away or withered away by the either inflation or debasement of the currency. And so we used we used bond proxies in our portfolios, and those bond proxies looked like a bond, paid a coupon like a bond. However, it had the asset protection and sort of inflationary protection in being a real asset. So rather than investing in a bond that's going to pay you a coupon, and by the end of it, your principal amount is worth nothing, we used what's called business real property, infrastructure assets, business real property like commercial properties, as a way to give us the exposure of a sustainable income that would be delivered with a bond fund, but to give us the asset protection that in an inflationary environment, those assets kept going up in value. And we also had the benefit of a compression of yield. So as those yields went from, say, a 6% to a 5% to a 4%, we had a 30% uptick in the value of the underlying asset, because of the financing rates on it. So not only did we get to deliver a yield, like a consistent yield that was dependable, that was a monthly income that the clients could rely on, it gave us the ability to have asset protection and allowed us to increase that client's assets, because the underlying asset that was generating that income was then growing in value. So it was really a no-brainer, and we had great success with a number of products of that in removing clients from a bond portfolio and putting them into a bond proxy, which gave them capital growth and the income attached to it as well.
So it sounds like you guys were fairly progressive, forward-thinking in terms of your investment thesis. even 10 years ago now, maybe more, you weren't just happy to outsource product sales into a classic 60/40 portfolio.
No, I think that led to some very disappointing results. And my business partner and I, um, we try and avoid disappointment with clients. want a surprise to the upside.
I think, yeah, that's probably the best way to go in any client services: under promise, over deliver. Um, so then talk to us about some of the challenges you faced. I mean, switching to or advising on Bitcoin in 2016 is early compared to
Mm.
most. If if even if even if someone is a class of 2016 themselves, that's relatively early. So to have a financial advisor talking about it in 2016 is incredibly early. So talk to us about some of the challenges you faced during that transition.
There were a host of things, but the biggest one is probably a lack of regulatory guidance on Bitcoin. And so, was it a financial product? Was it a commodity? Was it a security? It was not defined at that point in time. Now, because of the clientele that I had, basically very wealthy families, I was able to take a captain's call with a very small percentage of their portfolio. So, disregarding the regulatory risk or ambiguity around the actual advising on Bitcoin, firstly, we had to prepare a whole host of disclaimers and um, warnings that were given to clients. And if I can give you the TLDR on what those 4 pages of disclaimers and warnings boiled down to, was all care, no responsibility, i.e., only put in what you're prepared to lose. And that was because in 2016, it was a very, very immature market. You've got to remember, at this point in time, Coinbase was maybe only 3 years old, and that was arguably the industry leader at the point in time. In Australia, they were limiting capital purchases on or Bitcoin purchases in Coinbase to maybe $500 to $2,000 a week, but you had to have a track record. There were the inconsistencies and issues of purchasing Bitcoin on those platforms with cash. They wanted only cash. Fortunately for me, and this is where I'm very grateful to my brother, he had an exchange in the US, so we were allowed access to that exchange in the US, and we could purchase Bitcoin in any volume required by the client. So if there was $100,000 purchase back in 2016, which was a huge purchase, in that period of time, that $100,000 would have got you close to 150 Bitcoin. So today, what's that get you? Yeah, probably 15 million bucks would be required to get those 150 Bitcoin now. So it's a very different story to where we were and where we are now. But there were a whole host of workarounds that need to be considered, and this is where it really took two things. Firstly, a willingness of our clients to sign disclaimers, and that was, I think, a direct result of being authentic with them and showing them that with all of the advice that we deliver, I'm only prepared to advise on something that I'm prepared to put my money into, and I could show them wholeheartedly, hand on heart, that my capital was being put to work in this thing that I was asking them to do. And with the sort of the question, or how we framed it to limit the rejection of the advice, was to weight it accordingly. So we framed it as a 1% to 2% allocation of your portfolio is the equivalent to a bad day in the stock market. And we said, well, for a potential 100x payoff, let's risk 1% to 2% of the portfolio, and we'll do our best not to lose it or blow that up. But we could double the value of your net assets by putting in 1% to 2%. And this was a trade that most clients were prepared to go on, and they could see that I was taking a lot more risk with my capital. And I was happy to share that with them to show them that hey, look, you're going to lose some money, but I'll be losing more than you if this goes south. So I think most people are very comfortable with that conversation if you're authentic and can show them that, hey, you're not only talking the talk, but you're walking the walk. And so clients came along on that journey with us, and I think they've been really happy with the results of that.
I would imagine so. If you were putting 1 or 2% of their portfolio into Bitcoin in 2016, I mean, the numbers you just threw out. So yeah, you're looking at whatever it is, 150x or something in that time. So, and I think that's a really, really good point, which is selling in that asymmetric upside. So
Mm.
you could allocate 1 or 2%. If that goes to zero, you've lost 1 to 2% of your portfolio. If Bitcoin performs as expected in 2016, and it has played out exactly as I would imagine you pitched it to them, you're looking at 100x, 150x, 250x returns. That's a bet that you want to take every time, right? If you put £1 on for the opportunity to win £200, the most you can lose is £1, but you can win up to 200. And those kind of asymmetric upsides is definitely something that when I speak to people about Bitcoin, that's absolutely the kind of thing that I'm showing them. And the same as you, showing them that a much, much larger percentage of my personal portfolio is in Bitcoin. So
I think
yeah,
that's really important. And to those points, it garners confidence for your clients, and that breeds, I guess, an authority in the space. And from your client's perspective, you're looking after 98% of the rest of their portfolio anyway. So 2% really is not a big deal when positioned that way.
absolutely. There's lots that I want to touch on from what you just said, but actually one of the important things I think for the audience of this podcast, which is typically aimed at IFAs, accountants, wealth managers, what kind of challenges did you face when speaking to clients about it in 2016? And what I mean is, what sort of depth did you have to go into about Bitcoin? Was it a full-on, training course, workshop program, or how? And then how much was it? Look, here's what it is, and then I need you to trust me that this is going to, be a good investment.
I think it was initially positioned as an asymmetric bet to the upside, that clients, when they put money in, were fully prepared to never see that money again. And so that was a very different value proposition. That was really a conversation about the weighting or the percentage of the portfolio that was to go into Bitcoin. The conversation today looks very different to that. And ironically, I still think the asymmetric upside is 100x in front of us. So you can still be having those conversations of 1 to 2% having an extreme outsized return on a portfolio. But to me, it was making sure from a personal liability perspective that all of our ducks were in a row. So we had disclaimers for, we are endeavoring to be honest and give you our best efforts. We're endeavoring not to lose any Bitcoin, give you the best advice that we can, to find the most secure exchanges or the most secure way to custody your Bitcoin, and to give you access to this market that no one else really in Australia was able to buy Bitcoin at that point in time in bulk, unless they had a relationship with an exchange in the US. And I was just fortunate to have my brother in charge of an exchange in the US at the time that didn't have any limitations on the capital that we could send them, because we were a known entity, and all of our clients were known entities, so we could transfer that capital to purchase that. But it was a very different time. It was very difficult from a regulatory perspective, and it still is. There was no professional indemnity given on this advice, and there still isn't, because technically it's a commodity. So in the professional or financial advice space, investment advice space, actually advising on the underlying asset is still problematic for advisors. And until such time as professional indemnity providers are going to cover us for advising on the underlying, it's still going to be a very difficult or tricky situation for advisors to advise on. In Australia, under our regulations, one of the interesting carve-outs or provisions that we felt we could argue in a fair court system was the fact that because we're only advising on 1 to 2% of a client's portfolio, that it represented a minimal risk if there was a catastrophic failure with that investment. And by that, I mean the conversations with clients were very simple. It was a conversation around weighting and the fact that if this is a catastrophic failure, it's equivalent to a bad day in the stock market. It's not going to affect where you live. It's not going to affect how you holiday, where you send your kids to school, where you have fine dinners out. Nothing in your world is going to change. So to have that asymmetrical upside of doubling or tripling the net assets of someone for an inconsequential risk, and that's probably the key term, having it as an inconsequential loss, because 2% is meaningless, particularly the families that we're looking after. I don't mean to say that flippantly, it sounds like I'm saying it flippantly, but the real concern is a reputational risk that clients would feel silly that they've lost money. So we were very structured in our approach to ensure that clients felt comfortable that we were doing everything we could possible to ensure that there wasn't going to be a Mt. Gox, an FTX, a Celsius, or a BlockFi style blow up. It was going to be managed in a professional way that would give them the greatest peace of mind. And ironically, and this is sort of a study in human psychology right here, is as a percentage, 1 to 2% of a client's assets, no one cares, let me tell you. No one even blinks an eyelid at it. But fast forward when that's gone 100x, it's now 50% of a client's portfolio. It's a very different conversation, and clients are laser focused on this thing. And what's interesting is I spend more time talking about Bitcoin than any other asset combined in the portfolio, than the rest of the portfolio. And for new clients, we spend all our time talking about Bitcoin because it's the most important asset we can be talking about from a future return perspective. And this has played out exactly how I thought that back in 2016, we used to spend 50% of our meetings talking about Bitcoin. And to the point where clients were like, can we talk about, the 98% of the rest of the portfolio that you're looking after? I'm like, look, don't worry about that. That's going to look after itself. But I really need you to understand this. And the reason being is because if I could have, and this is what my goal was, is to start them at 1 to 2%, but then work them to get comfortable with 5% and then 10% and then 25%. And I'm proud to say we've got clients who've got 100% of the net assets in Bitcoin.
Wow. Yeah, it becomes a very different conversation once that 2% now represents 50%, right? And there's lots that I want to touch on there in terms of when people are in retirement, what assets do you sell? Because people say never sell your Bitcoin. Before we come on to that, let's talk about the logistics of how you've actually got the Bitcoin within their portfolios. And the reason I want to bring that up is because in the UK, we're unable to put spot Bitcoin, so on-chain Bitcoin. We can't put that within our tax wrappers, so within our pensions, within our ISAs. Retail does not have access to Bitcoin ETFs. We have a UK ETF. It was launched a few years ago, a chap called Peter Lane. I don't know if you know him. And we're unable to even access this UK Bitcoin ETF within our tax wrappers, which means we're obviously driven into, listed NASDAQ companies. I won't name them. You're aware of them. But then those have, a leverage play. So, they become even more volatile, and volatility is a bad word within the UK financial advice landscape. So talk us through the logistics there of how you actually managed to buy spot Bitcoin, hold it for your clients within portfolios, within pensions. Hey team, a very quick pause. If you're a financial advisor, wealth manager, or accountant, there's a very good chance your clients have already asked you about Bitcoin. And if they haven't, they soon will. That's why I've created 2 free downloads to help you feel confident and informed and ready to have professional conversations with your clients about this new emerging asset class. Head over to thebitcoinifa.com to get 1, the 8 reasons you need Bitcoin in your personal and professional portfolios, and 2, the Bitcoin cheat sheet, a concise, jargon-free guide designed to help you go from zero to confident and knowledgeable in under 10 minutes. Whether you're Bitcoin curious or Bitcoin cautious, these resources will help you speak with clarity and confidence. It takes less than 60 seconds. Again, that's thebitcoinifa.com and enter your email address to get your hands on these free resources today. Now, back to the episode.
Well, in the pension system, we have to set up a self-managed super fund in order to hold the underlying asset. So you need to have a self-managed super fund. You need to roll your pension balance from either a retail or an industry superannuation fund into your own self-managed super fund. And then with that self-managed super fund, you can set up an exchange account and then transfer that money to the exchange, buy the Bitcoin there, and then we have a method of self-custodying the client's Bitcoin so that there's no risk in them leaving Bitcoin on exchange, because we don't leave Bitcoin on exchange. And that reduces the risk of phishing attacks, social engineering, clients mucking things up into a system and a process that ensures that they can self-custody, which reduces the risk of Bitcoin dramatically. And in the event that they don't wake up tomorrow, or they don't have, they pass for whatever reason, we can recover their Bitcoin, because the most important thing for me as an advisor is we hold a fiduciary duty to our clients to ensure that we're giving them the best possible advice that's in their best interests, not my best interests. And this is where I've had a host of conversations with my father, who's an extremely successful businessman. And the process we go through with clients is we go through all of that. We set up the exchange, we help them buy Bitcoin, and then most advisors would leave it there and go, oh, well, I've done my job. No problems, they've got exposure. But I wasn't happy with that, because that wasn't how I wanted to custody my Bitcoin. I wanted to self-custody my Bitcoin because it reduced all of the risks associated with Bitcoin. That then led us to creating a process that we call collaborative security, where we basically put a client into self-custody, but we do it in a way that ensures that regardless of what the client does, they are unable to lose their Bitcoin, because we work with something called a multi-sig, where the software provider holds a key, the client holds a key, and we hold a key, and that provides a system and a process that ensures that there's no single point of failure in that client setup. So they literally can die and they can't lose their Bitcoin. And this was my greatest fear, because Bitcoin being a digital bearer instrument and having a fiduciary duty to my clients, I wanted them to have the best custody solution that they could have. And I understood that that was self-custody. But my fear was, if we were telling clients to buy millions of dollars of Bitcoin and walk out the door with millions of dollars on a little hardware device like a USB stick that they'd never used before, rightly or wrongly in my head, I'm thinking, I am in trouble, like that South Park skit where the guy's about to get munched and he realizes, I'm in trouble. It's Simpsons, sorry. And you don't understand how much risk you're carrying, because now I'm responsible for the client's good custody of a hardware device that they've never seen, never used, have no idea what that looks like. And if Bitcoin 100x's and they've got $1 million on there, they're sitting on $100 million on a little hardware device. To me, I was terrified. I was like, we need to find a better solution. So hence the sort of tension creates outcomes. And this is how we came up with collaborative security, because I didn't want to forfeit on self-custody with clients. I wanted them to self-custody, because if they were self-custodying their Bitcoin, then we removed the risk of Bitcoin from them. In that, I'll go into this probably a little bit later, but when they self-custody, they don't have the exchange risk, they don't have fear of loss and things like that. They've just got to manage that key. But I wasn't happy, leaving our baby boomer clients who had no technical knowledge of this with that. So we came up with collaborative security as a way to give them the best of both worlds. They've got full control, self-custody of their Bitcoin. There's nothing they can do to lose it. And most importantly, there's no single point of failure, that in the event they don't wake up, they're not going to lose their Bitcoin, or most importantly, their beneficiaries aren't going to lose their Bitcoin. And sadly, we've been through 3 probates now where clients have passed, and we have successfully transferred every single Satoshi. So the system, the process works, and that's really all I care about. Having, losing one Satoshi is a catastrophic failure for our business, and I'm proud to say that we haven't lost any. But these are all the machinations and the considerations that we had to consider that I didn't think anyone was considering at the time, and that goes all the way back to nearly 10 years ago.
Wow. Yeah, that's very ahead of its time. Sad that you have to lose a client to prove that quality control, but positive that you've gone through those probates, never lost a single Satoshi. Um, it sounds like the UK and Australia are miles apart in terms of regulatory differences, because if you can hold spot Bitcoin within your tax wrappers, not have to pay capital gains, I assume when you sell them to when you're in drawdown in retirement, that's so wildly different. Because yeah, at most we can buy paper Bitcoin through an ETF, maybe. It's very difficult. Or we're buying stocks and shares essentially within our tax wrappers, and anything that we hold on chain multi-sig wallets is outside of our tax wrappers and liable to all kinds of taxes, capital gains, etc. So talk us through those. Are those the only regulatory differences that you're aware of between the UK and Australia?
I think they're the biggest ones. Sadly, we don't have a tax advantaged savings account like your, is it your SIP account or your ISAs?
So SIP is the pension, ISA, yeah, is an individual savings account, and they can be cash or they can be stocks and shares.
Yeah, we don't have the ex pension savings accounts that are tax advantaged that you do. So we're really only working with the pension system. Um, the other sort of key difference is that we can advise on basically the Bitcoin ETFs here, and sadly, it would have been a lot easier for my job if I could have just whipped everyone into an ETF nearly 10 years ago. But again, that's probably a lesser outcome from a risk adjusted perspective. But all in all, it's a very similar regulatory framework, and this is where what I'm looking forward to on a regulatory perspective is with the repeal of SAB 121 in the US, whether we Commonwealth states like it or not, everything is downstream of the US, and as hard as it is to acknowledge that, that literally is what happens. And with a positive, a pro crypto government coming into the US, we're now going to see policies that change. And I will be shocked if there isn't huge regulatory change in support of Bitcoin in the next 12 to 24 months that will rescind those restrictions across advisors. And this is where I think the opportunity for financial advisors rests, because if you're ahead of that curve, then you're going to be able to take advantage of that. And there is a huge groundswell of support and interest in Bitcoin. And to me, there are many reasons that you want to sort of focus on this, but just from a self-interested perspective and future-proofing your business, you look at, say, my business, which was typically baby boomers. The advent of investing in Bitcoin has been really good because the next generation doesn't want to own bonds and everything else. They're far more interested in Bitcoin. And so straddling that generational gap between the boomers and their children, being sort of forward thinking and having Bitcoin in the portfolio makes you far more amenable to the next generation who's going to inherit it. And then one of the questions that you raised earlier, which was really important, which I didn't answer, sorry, was how do you think about it from a portfolio construction perspective when clients get older and the bonds and the income and the rest of it? It's like, well, without wanting to sound too privileged, a lot of my clients are in a very privileged position that they're never going to be able to spend what they've got. And so once you understand from an advice perspective that they never have to, we're not really investing for them because they've got more than they need for the rest of their lives. They can't spend what they've got now. And so once that is acknowledged by the client, and we've got plenty of older clients, once that's acknowledged by the client, then you can reframe that investment conversation around not focusing the investment on a 60-40 portfolio that's in ultra conservative shares and a treasury 40% in treasury bonds. You can then focus the conversation on creating a investment portfolio that is focused on the next generation, that's going to ensure that they've got enough to live on. So therein lies the conundrum that you really need to, this is how we approach it anyway, you want to be creating a portfolio that is not only going to look after the existing generation and see them out, but it's going to make the next generation coming into that wealth a success and ensure that they're left in a position that they can leave something for the next generation after that.
Yeah, completely agree with that, Pete. I like to visualize it as sort of boomers and Gen X were great in their 60/40 portfolios, and then millennials really had to start looking at global equities. Gen Z probably had to niche down into the Mag 7 tech, and then I believe it's Gen Alpha now. We've gone full circle. So Gen Alpha is, I think, after 2005 or 2010, something like that. Pretty much the only way out of currency debasement for them is Bitcoin. So we are going to see this movement of wealth down through the generations once the majority of boomers, millennials catch on to the fact they're like, oh, there's this thing called Bitcoin, where you've got Gen Z, Gen Alpha already own it. And I also think we'll see a redistribution globally as well, because people outside of the global north there's going to be huge demand. So I think what Saylor says, by the time your financial advisor is advising on Bitcoin, it will be $10 million a coin. So, there was something, yeah. There was something you touched on there, which was sort of talking about the construct of the portfolios. Let's go into why did you focus on Bitcoin and no other crypto assets?
To me, there was only one investable asset in the crypto landscape, and that is Bitcoin. It was the first, it was the best, it was the only one that hasn't been corrupted. It had what's the Immaculate Conception? So there was no pretense of any corporations corrupting it, any person in charge of it. It was pseudonymous or anonymous with Satoshi creating it and then backing away from the project. Once you dig into the mechanics of Bitcoin, you realize that this is the only one that could work. Once you study money, you realize that money accrues to one or tends to one, so there can only be one. When you look at networks, you realize that the network effect happens and it gets bigger. And this is probably the hardest thing about Bitcoin, is that there has never been anything quite like it. You can describe it as a monetary network, you can describe it as money, you can describe it as collateral, it can be a store of value, it can be a medium of exchange, a unit of account. It can literally be anything you want it to be. It's malleable software at its very core, and it's literally a network before anything else. We put a monetary construct on it because that's what we value and that's what's important to us. So it's very, very difficult to wrap your head around what this thing is. But the more time you spend looking at it, the more holes in everything else that you find. And this has been the problem for me, is that I've been staring at this thing for over 20,000 hours. And typically it takes me somewhere between 1 minute to 1 hour to find what are the holes in the deal or the investment that we're looking at. And yes, there are some concerns around Bitcoin. I won't say that it's completely perfect, but it is so much better. It's daylight second relative to any other investment opportunity out there. And ironically, the conversations we were having in 2016 where, hey, there's 100x in front of you over the next 10 years if this thing catches on, I still think that conversation is valid. I still think there's 100x in front of us in the next 10 years if this catches on. And ironically, I'm probably one of the few people who have been able to say we've given advice on this asset for the last 9 years or over 9 years, coming into our 10th now, where we can say that clients got over 150x return in less than a 10-year period. And so I can say with full authority and authenticity that I genuinely believe that there is 100x in front of us over the next 10 years. And ironically, that would suggest it's a 66% less return over the next 10 years than the last 10 years.
Still probably going to be the best performing asset of the next 10 years in the same way it has been for the last. Yeah.
On a risk adjusted basis, I think absolutely. And this is where, as advisors, we get lost. I don't think a lot of us as investment advisors really understand what risk is. To me, Bitcoin represents an opportunity for those who are in poverty or those in extreme wealth to protect themselves from falling into or elevating themselves beyond their current positions. And this is where, if you look at, say, some of the things I think about is, if you're familiar with the Laffer curve, which is basically a curve which calculates what is the maximum percentage tax rate you need to charge in order to maximize your tax revenue, it looks like an umbrella. To me, Bitcoin and the advice as far as a percentage of a client's portfolio to be allocated to Bitcoin looks like an upside down umbrella, a convex line, in that if you have nothing, then you should have 100% in Bitcoin, because guess what? You have about that far to fall. It doesn't get much worse than having nothing. So basically chuck it all in and hope it works. And then if you have everything, or you're worth billions, then you can chuck in 900 million out of your billion, and you're still going to have your boat, your car, your holiday home in Aspen or Courchevel, wherever you are, and nothing's going to change. And so it's really those who are in the middle class who have to sort of not go all in, because they need to maintain the mortgage, the school fees, and everything else. But if you're on either end of that wealth spectrum, then it looks like you're good to go for 100% of your portfolio.
Absolutely love that. Yeah. I use something similar in my workshops and my trainings, which is, I like to call it the engine and the vault. So the vault is global equities, which is essentially just locking up your buying power, right? So it gets 10% a year. That's basically that's your hurdle rate. Overlay global equities with printing in the stock market or printing of currency, and overlay global equities since 1971, and they're essentially flat. So global equities protects your buying power. Then you've got your engine, which is Bitcoin. And the percentage that you allocate to each is completely subjective, but certainly the younger and broker you are, you want more in the engine to drive wealth than you do in the vault, because you haven't got any wealth to protect.
So true. Yeah. It's so true.
So I love that. Yeah, the upside down Laffer curve. And actually the Laffer curve is something that I've only become aware of in the last probably few months, 6 months, something like that, because the UK government seem intent on proving that it's real by forcing the very wealthy out of the country.
I saw there was a $20 billion shortfall the government's got to make up, so they just get the Chancellor to print 20 billion in bonds to make good.
With the most worrying thing about that is that a few days before the end of the financial year, the Office of National Statistics came out and said, no, we're going to be fine. Like, the budget looks pretty balanced. And then literally within a week, move into the next financial year, and they were like, oh, no, wait, we're 15 billion short. And you're like, how are you operating on this data that changes within a week to be so wildly out? But anyway, that's another matter. This is the Bitcoin IFA podcast, not topical news. So, what strategies have you found to be most effective when educating both clients and financial advisors about the value and the scarcity of Bitcoin?
Ooh. To quote Nassim Taleb, nothing really educates like skin in the game. Nothing motivates like actually being able to, like, real money that hurts if you lose it. So it's funny. A great mate of mine, Jeff Booth, who is one of, if not my favorite Bitcoiners, and I can tell you in real life, he is just a great human being with a gorgeous family. He focuses on education and says, hey, you really need to understand this asset before you invest in it. And this is one of the few disagreements I have with Jeff, in that I'm like, that's good, but I would prefer to take the other side of that. And I want clients to invest way more than they're comfortable with, and provide put them in floaties, wrap them in cotton wool, make sure they can't hurt themselves, but get them exposure to this, so that once they have skin in the game, they've got money down, they are now highly motivated to understand what this thing is and learn as much as they physically can. And this is where the conversation I had with a client who just walked out of here maybe 20 minutes, half an hour before we started. early 70s, has been in Bitcoin for 4 or 5 years, and we have a really deep, in-depth conversation about Bitcoin, and he tells me he watches at least 30 minutes on Bitcoin every single day. How does that happen? Well, he's got a high exposure to it and he wants to understand it. And what's really interesting is understanding Bitcoin and understanding how Bitcoin is influenced by macroeconomic forces gives him a much deeper understanding and appreciation for how that's going to affect and impact the rest of his portfolio. And this is where I think understanding Bitcoin is literally upstream and the rest of the financial world is downstream of it. Now, this might seem like a fairly extreme view that I have and you have, I'm not sure if you agree with me or not, but the rest of the finance world is going to figure that out in their own time. And Bitcoin is literally re-terraforming the entire financial universe to beat to the Bitcoin drum as opposed to the central bank drum. And this is where if you can embrace that, understand it, and be ahead of that curve, you have a unique advantage as an advisor to put your clients in a position that is going to be extremely advantageous to understanding what are the best stocks, what are the best convertible notes, what are the best bonds, what are the best income ETFs, what are the best options out there. All of a sudden, it is, to quote one of the UK's great Bitcoiners, it's a cheat code.
Indeed. I was at the Cheat Code conference a few weeks ago. I actually met a 75-year-old man who has moved to the Bitcoin standard. So he does van life, has 100% of his net worth in Bitcoin. There's a debit card that obviously converts from Bitcoin to fiat in real time whenever he wants to buy something. It was astounding. But I think I've often said to people to just put a little bit in, so like £100, £200, and then just to ride out the volatility. So like put £200 in, forget about it for 2 years, see what happens. But I quite like the recommendation to put in slightly more than you feel comfortable losing. And then yeah, once there's skin in the game, people can't help but do the research. That being said, I mean, it can be hard for people to get their heads around. I know that there can be fear of failure, should we call it that? So like and have you found that with clients that they can have that initial objection or fear because they feel like they're never going to understand it?
That's a very good question. I've never seen posed like that. You know what? There are two clients in my entire universe who I haven't been able to convince of Bitcoin. One of them is, well, they're both very intelligent. One of them is extremely successful, very good at his job, and understands finance and the nuances of it probably better than 99.9% of the known universe. And the other was a client who worked in software and just could not get his head around how this worked and why there would be a monetary premium to a software and refused to do that. They're my two failures that I'm hoping to rectify. But I think the toughest thing for clients to get their head around is ensuring that they don't look stupid to their friends and family. And this is where it's so important. And we're social beasts. So the most important thing, whether we like it or not, is, or one of the most important things is saving face. No one wants to look stupid. And this is where if you can remove the risk of looking stupid by investing in Bitcoin, then you have a much greater chance of success. And this is where it's really important to start with a very little allocation with a huge upside attached to it, because that lowers the reputational risk of losing face that a client would have if you just said, hey, we're going to put 50% of your net assets in it. And most people would look at that as taking 50% of your net assets to a blackjack table and calling, hey, we're all in on black. But that's not how I perceive it. But to someone who's not in Bitcoin and new to Bitcoin, that is how they perceive it. And sadly, my perceptions mean absolutely nothing to the client who has to commit to the investment decision. And this is where the process is a slow one, but one of my favorite Bitcoiners is Gigi, who says, the more you know, the more you buy. So this is where I think working with an advisor and being a proactive advisor to be ahead of your clients on this journey is really powerful, because regardless of what happens, whether it's markets up or markets down or some new threat to Bitcoin, some new FUD, you name it, you're ahead of it. Clients need leadership, and they need to ensure that you've got their back, and they want to be doing things that they're not going to regret. And this is where Bitcoin represents that opportunity, depending on how you position that as an advisor. And that's ultimately what it comes down to.
Yeah, completely agree. Although you and I might be, to use your blackjack analogy, we're not all in on black, we're all in on orange. But for an advisor to go and recommend that to a client from the off, that's really good advice. That you're essentially protecting both the advisor and the client's reputational risk. Certainly in the short term, if you were to put, one of the things I talk about with advisors, which is, advisors generally don't want to be traders.
No.
And I totally get that. But Bitcoin does have an observable historical 4-year cycle. And you don't need to be a trader, but you need to know which year you're in, so that if you are recommending we're moving 5% of your portfolio in, and you're doing it at what is likely to be a top based on historical cycles, that's over the next 6 months or 9 months from now, you need to be aware that there historically have been 50 to 70% drawdowns from there. So you need to have that conversation with the client that we're not going to over-index, and it's a minimum 5-year investment before we even start to think about selling any. But if it goes as well as we hope, you're never going to want to sell it.
It's funny, I struggle with that. Clients never wanting to sell it. There is always a desire to get their original capital back. It's funny.
So even if you've put 2% in and it now represents 50% of their portfolio, they want that 2% back out.
I want the 100. I've got 5 million in there now. I want the 100 grand back. It's like some cognitive dissonance here. I don't know what the term is, but it's a bizarre human quirk that, all right, now I can't lose. I'm happy to lose $4.9 million, but I want the 100 back.
And how do you typically counter that?
No, you're not doing that. You can tip another 500 in.
Okay, so Pete, I think we've kind of touched on some of this, but let's just spell it out. So, what do you feel like are the given the regulatory environment that I've described in the UK, and I'm sure you're pretty much aware of, what do you see as the biggest challenges for advisors, but also what do you see as the greatest opportunities for them over the next year, 2, 3, 5?
Oh, I think the regulatory clarity is really disarming. There's a problem there that advisors have to deal with. It's a very real concern, and that is upstream of the concern that you don't have professional indemnity. The very fact that, and this is the juxtaposition that represents the opportunity and the potential problem with Bitcoin for anyone advising on it, is it's an asymmetrical bet to the upside. But if you look at the current lay of the land from a regulatory framework, professional indemnity, and your dealer group or network, I think you call it in the UK, it's an asymmetric downside bet, because there's very little pay attached to it. You're flirting with regulatory ambiguity. Your professional indemnifier will not cover you, and you are taking on huge professional risk to advise on what many believe is still a really risky asset. So I look at this and think, either you're going to have some really good legal disclaimers in order to give advice on the underlying asset, or you're going to have to work smarter around how do we work around the current system that we've got, which I think will be a totally different outlook in less than 5 years. And if I was an advisor in the UK, what I'd look to is, well, what are the financial products / securities that I can advise on that are going to give my clients the exposure that they need for the upside, and this is where the clients will come to understand Bitcoin and the value of holding the underlying as opposed to a security or an ETF or whatever it might be. But just to get them the physical, like the exposure to Bitcoin and the number go up technology so that they can actually have an uplift in their portfolio value, then I'd be working really heavily on understanding what are the marketable securities that you have access to across any of the platforms or tax structures that you've got available. And if Bitcoin's unavailable, then in the last 12 months, there's been a proliferation of financial products that you can now put in there. Now, an ETF might not be available, but there are still a whole host of other Bitcoin proxies that weren't available 12 to 24 months ago. So I think just do your homework, look around and find what are those options. And then the real conversation is, how are you going to weight that in your client's portfolio? So to me, that's the $1 million question. How, given that you're advising on approved products that your brand of financial advice allows you to advise on, how can you work with their compliance team to get the largest exposure possible to those core marketable securities that are Bitcoin proxies? And that's how I would work it, because I think over the next 10 years, not only will your clients really love you because you'll have portfolios that outperform market relative to anything else, but it sets you up in a position to be an authority. And then once the authorities approve Bitcoin as a marketable security or an approved product to talk about, you'll be in a position of authority to then talk about that. And then that opens up the opportunity to increase the weighting of the client's portfolio. So in our world, I've gone about it very differently, but in the UK, you'd work back in the complete opposite way. So we work on having our clients maximum exposure to Bitcoin. And then we work on the market. Once the clients have said, Peter, I'm tapping out, I need to stop on this Bitcoin, there's too much in the portfolio, I say, right, no problem. Let's talk about equities. And then you find a Bitcoin proxy that is that is similar or the closest thing you can, and you talk about it as being diversifying because this isn't Bitcoin, this is an equity, and it's fundamentally the same thing. We all know it. The funny thing is, and sort of I laugh about this, but the clients know it too. They're just happy to hear whatever spin you want to put on it to, okay, right, so this is clearly important to have more exposure. And that can come in the form of many things. It might be a listed miner, Bitcoin miner, it might be a Bitcoin treasury company, it might be, who knows, any other Bitcoin proxy. But that's where the conversation goes from Bitcoin to Bitcoin equities and then maybe income ETFs, things like that. Whereas in the UK, you're probably starting at the other end, talking at basically Bitcoin proxies by way of marketable securities and then working your way back to Bitcoin once it's approved.
Yeah, that's a great answer, and that's exactly what I sort of train and teach in my workshops, which is within the current regulatory landscape. It is securities and equities, stocks, shares that are essentially Bitcoin proxies, but that comes with knowledge about what sort of leverage they're at in terms of Bitcoin. But it's really interesting. I had Alan Smith on recently, who's a very well-known IFA in the UK, and we were talking about Bitcoin's ARR 60% a year. And if there was a fund manager, if there was an ETF, global ETF that was getting 60% ARR every year, everyone would pile into it. But for some reason, Bitcoin, everyone's afraid of Bitcoin.
Oh, Bitcoin. It's got herpes. Yeah.
Pete, from a business perspective, what's been the impact of moving to advising on Bitcoin?
Hey team, just a quick pause to say a huge thank you. You've given us your most precious assets, your time and your attention. And honestly, it means the world to us. If you've enjoyed this episode or you take value from these conversations, it would really mean a lot if you could like, comment, or subscribe. Those things really help the algorithm and they help the channel to grow. And if there's someone in your life who would take value from this, maybe a fellow advisor or someone just curious about Bitcoin, please send it their way. You never know what it might spark. Okay, back to the studio.
I think there's two focus to this question. The first is a monetary component to it. I can tell you that it has increased our revenues dramatically. I would have thought just short of over 5x and just less than 10x. So there's been a dramatic improvement over a 10-year period. Yes, there's been an uptick in portfolio values and the rest of it, but there's been a meaningful increase in revenues associated to the business as well, which is always helpful. And given we're talking to financial advisors, we're always looking for ways and means to increase revenues. There's an ancillary benefit that clients, their portfolio values have gone up dramatically, and that has created a flywheel for further opportunities, referrals that ensure that if clients are talking about their portfolios, we get a really inordinate amount of referrals from our clients. So it puts you up the pecking order. One thing in Australia, Australians love to do, and I'm sure there's an equivalent in the UK, we love talking about property prices, and we love talking about how good at property investing we are. And then the conversation inevitably comes up on what does your portfolio performance look like? And then for all of our clients who have Bitcoin in the portfolio, 3 out of every 4 years, they look really, really good. And they have one bad year. But over time, they outperform dramatically. And this is where the secondary or ancillary benefit to having a focus on Bitcoin has meant that we are ahead of the curve when it comes to seeing opportunities in the broader markets. I think Bitcoin is a forcing function for finance, and we're seeing the most successful equities on earth are all Bitcoin treasury companies. The most successful convertible notes or bonds issuance, pretty much in the last 4 years, the only bonds that have had a positive real return have been downstream of a Bitcoin treasury company. And now we're starting to see a whole host of other financial products that are built around the world of Bitcoin. In fact, the most successful or highest paying dividend or income ETF is downstream of Bitcoin. And this understanding Bitcoin as the primitive allows us to have a much deeper understanding of the derivative of Bitcoin in the equities, the convertible notes, the bonds, and then the income funds. And that sets us up for a really neat flywheel or a virtuous cycle that enables us to get clients into these products much sooner, way ahead of schedule, way ahead of traditional finance or Wall Street, Main Street, you name it, because we have an understanding of what the underlying asset is in Bitcoin, and then we can identify opportunities in the broader financial markets that are taking advantage of Bitcoin. So I think it's twofold. There's a monetary benefit. There's obviously the ancillary benefit of having clients who are really happy talking about, hey, we've got Bitcoin and you don't. And it's such a rare thing to be able to talk about Bitcoin with authority. So you put yourself in a very unique position to accept referrals from anyone else. And then the final thing is being ahead of the curve when it comes to traditional finance, and then being able to integrate that into client portfolios is another net benefit. So I look at this from a business perspective. It's all upside and very little downside.
I think that's a great answer. And essentially, it all comes back to making clients happy. So you make your clients happy because you've increased their portfolio size. They go and recommend you to other new clients. And yeah, as an advisor, your income goes up because your clients' assets are going up if you've got an assets under management model, and they're recommending new clients.
Win-win-win.
So talk a little bit about what the Bitcoin Advisor does, because you are able to accept clients from the UK.
It's really on the back of the service that we were delivering to our families in ensuring that clients can self-custody their Bitcoin. So about 2 years ago, a Bitcoin mate of mine, Andy, who's the co-founder of the Bitcoin Advisor, thought, hey, there's an opportunity for us to deliver this service to the world. Bitcoin is a global asset. This service is a global need. Ironically, we now service clients in over 20 countries globally. And it's a really neat service for anyone who either lacks the confidence or the technical skills to self-custody their Bitcoin. We're a service which will not only help you self-custody your Bitcoin, but ensure that you can't lose it. And most importantly, we wrap that with a fiduciary duty and an estate plan protocol around the recovery of your Bitcoin in the event that you don't wake up. So this is, I think, a really important thing for anyone self-custodying their Bitcoin. What I like to describe it as is there is this misconception with Bitcoin that people think Bitcoin is volatile and risky. But what they're really confusing is they think it's risky, but what they really mean it's volatile. And so what this service does, I believe, in whole, is Bitcoin Advisor basically removes the risk of Bitcoin from your portfolio because you now have a professional team looking after you to ensure that you cannot, literally, you cannot muck this up. So your self-custody is 100% secure. And then that lets you deal with the volatility of Bitcoin. And now the solution to volatility is basically duration. You hold on to it for 5 years or more, then you never have a problem with Bitcoin. But if you don't solve the risk problem, and there are a multitude of risks that I won't go into for preservation of time purposes, but we've seen every mistake made just about in self-custody of Bitcoin. And the service is purely designed to ensure that there is no way that you can lose your Bitcoin while you self-custody it. And this is a service that was effectively developed for myself and then passed on to clients. And then we've now opened that up to clients all over the globe.
Well, it's a great service, and I am a customer of the Bitcoin Advisor. You custodian my Bitcoin, so I walk the walk with this one. And I will just highlight that there will always be a link to the Bitcoin Advisor in the show notes. So if anyone wants to come and speak with you, they absolutely can. Click the link in the show notes. Pete,
thank you.
Final question. What is one positive thing that Bitcoin has brought to your life outside of number go up?
Oh, you know what? That's a great question. And I think in light of my last comment on Bitcoin being volatile, not risky, this will seem counterintuitive. But I sincerely believe that Bitcoin has brought a level of peace of mind or calm to my outlook for the future. It's made me exceptionally hopeful and optimistic that we have a really bright future in front of us. I don't mean to dismiss, the day-to-day problems that we've got in front of us, but I think as more and more people buy Bitcoin, hold Bitcoin, and realize the power of it, this is going to breed a calm amongst those Bitcoiners. And this is a common trait that I've spoken to hundreds of Bitcoiners across the globe, that having Bitcoin gives me a peace of mind that I just would not have otherwise. I think if I was subjected to the day-to-day news and barrage of bad news and all of the misgivings that we see in the world today, without having that counterweight of Bitcoin for hope and opportunity and the thought of a brighter future, I think I'd be really depressed. And this is where I'd say peace of mind is the number one thing that Bitcoin's given me.
That's a great answer. And yeah, Peter, I like Joe Bryan was on recently, and he said something similar, which is hope brackets expectation. So hope implies that it may not come true, but with Bitcoin, we know it's inevitable, and we have that expectation that we'll fix the money, we fix the world.
Yeah, it's a great question.
Pete, thank you so much for coming on. If people want to find you or follow you, where can they?
The best place is to find me on X at Peter BTC Advisor with an ER, not an OR, or alternatively, thebitcoinadvisor.com. And again, advisor with an ER. There's a stack of resources there. You can download a chat GPT bot if you want to find out about how we do what we do. There's no trademarks. We give away all of our IP for free because we want to make sure that people are doing the best they can to self-custody. So please reach out if there's any questions, any help that we can give. We'd be honoured and humbled that you'd trust us to do that.
Thanks, Pete.
Thank
Enjoy
you.
your day.